It was American comedy writer Robert Orban that said, "Life is a lot simpler when what we honored was father and mother rather than all major credit cards." In this lesson, we're going to define basic vocabulary of credit cards, and we're going to compute an average daily balance. All to answer the question, what do I need to know to use credit cards? Before we get into it, let's make sure we're ready for this lesson by taking a look at warm-up number 2. A company has 50 employees. 40 of them earn $100 per day, and 10 earn $60 per day. What is the average daily salary for the 50 employees? Well, if 40 of them earn $100, that would be $400. And 10 of them earn $60 a day, so that would be $60, meaning it costs $460 every single day. Now, while it costs $460 every single day, if we divide that by the 50 employees, then we get an average salary of $92 per employee every day. Now, let's take a look at a problem that you will be able to do by the end of this lesson. Rebecca did not pay last month's credit card bill in full. Below is a list of her daily balances for her last billing cycle. Let's find Rebecca's average daily balance. The average daily balance is an arithmetic average. The arithmetic average is also called a mean. To find the average, you add the balance for the entire billing period and divide by the number of days. By adding up all of these days, we can see that we have 30 days in this billing cycle. With 7 of those days owing $456.11, then we get $3,192.77. 3 days owing $1,177.60 gives us $3,532.80. We do this for every single one of the entries where we multiply the balance that was owed by the number of days it was owed. Then we add up all of these numbers to get $43,248.05. Now, dividing this by the number of days, which was 30, we get $1,441.60 as the average daily balance. We're going to need to define some basic vocabulary with credit cards. Credit cards were introduced in the 1950s. A credit card is a plastic card that entitles its holder to make purchases and pay for them. The issuer of the card has given the person whose name is on the account a line of credit. The account holder of the credit card has signed an agreement to pay for any purchase made using the credit card. Credit cards are so prevalent today that they seem more popular than cash. Businesses that honor credit cards think that consumers spend more money when they have to sign their names. It is mentally different than removing cash from your wallet when paying for something. The use of a credit card probably increases impulse buying. Impulse buying is when a customer purchases something to which they suddenly were attracted to and had no intention of buying. The convenience of using credit cards can also attract new customers to store that accept them. Credit cards have turned online shopping into a regular habit. Customers enjoy many advantages when using a credit card. Like there's no need to carry a large sum of cash. Responsible use of a card helps the credit rating or FICO score. Customers receive or have access to a written record of all purchases, and some cards have rewards programs such as frequent flyer miles or cashback programs. There are 2 types of credit card accounts. The most commonly used is a revolving charge card. This means that the entire bill does not have to be paid in full each month. There is a minimum monthly payment, and there is a finance charge the month following any month the bill is not paid in full. Customers have the convenience of stretching out payments over many months as they choose. However, the interest costs for doing this are relatively high. Popular revolving charge accounts are Visa, MasterCard, Discover Card, and some American Express cards. A charge card is a special type of credit card. Unlike the cards with revolving charge accounts described before, the monthly bill for all purchases must be paid in full. There is no interest charge. Popular charge cards used today include certain types of American Express cards. Most people informally use the word charge card or credit card interchangeably. Using credit cards is both convenience and responsibility. There's a great temptation to overspend. Cards can be lost or stolen. The Truth in Lending Act protects you if your card is lost or stolen. If this happens, notify the creditor who issued the card immediately. You may be partially responsible for charges made by unauthorized users of your card you lose. The maximum liability is $50. You are not responsible for any charges that occur after you notify the creditor. If the credit card and not the actual card is stolen, you are not responsible for any of the purchases. It is the responsibility of the person selling the merchandise to make sure the purchaser is actually the card owner. The Truth in Lending Act also requires all creditors to disclose key information about credit card fees in the same exact format so customers can easily read it and compare credit cards. This information is in a box on the credit card bill called the Schumer box, after Senator Chuck Schumer, who sponsored the legislation. On the screen is an example of a Schumer box. Cardholders receive a monthly statement of their purchases and any payments they made to the creditor. The Fair Credit Billing Act protects you if there are any errors in your monthly statement. It is your responsibility to notify the creditor about the error. You do not have to pay the amount that is disputed or any finance charge based on that amount until the problem is cleared up. If you find yourself unable to meet payment requirements by a creditor, notify the creditor immediately. The Fair Debt Collection Protection Act prohibits the creditor from harassing you or using unfair means to collect the amount owed. As you can see, you need to be knowledgeable to responsibly use credit and charge cards. Another type of plastic card is known as a debit card. Though it may look the same, a debit card is not a credit or charge card because there is no creditor extending credit. If you open a debit account, you deposit money into your account. The debit card acts like an electronic check. You are deducting money directly from your account each time you make a purchase using a debit card. You cannot make purchases that exceed the balance in your debit account. Keeping a record of your debit card activity is exactly like keeping a check register that we learned how to do in a previous lesson. The Electronic Funds Transfer Act protects debit card users against unauthorized use of the card. They are not responsible for purchases made with a lost or stolen card after the card is reported missing. At some retailers, when you use a debit card, you are charged a fee similar to the fees charged at an ATM. Revolving charge account credit cards can have higher finance charges, so it is important to verify the finance charges in your monthly statement is correct. Frank lost his credit card at a local mall. He notified his creditor before the card was used. However, later in the day, someone found the card and charged $700 worth of hockey equipment on it. How much is Frank responsible for paying? By the Truth in Lending Act, Frank is responsible for paying nothing because he reported it lost before it was used. Now let's check your understanding. Carrie's credit card was stolen. She didn't realize it for days, at which point she notified her creditor. During that time, someone charged $2,000. How much is Carrie responsible for paying? $50 is the maximum liability under the Truth in Lending Act. Credit card companies issue a monthly statement. Therefore, APR, the annual percentage rate, must be converted to a monthly periodic rate. If the APR is 21.6%, what is the monthly finance charge? Knowing that the APR is 21.6%, if we divide that by the 12 months, we find that we get an 1.8%. So the monthly APR is 1.8%. This is the percent that will be used to compute the monthly finance charge. There are several methods that credit card companies use to calculate finance charges. They all begin with the APR and then compute a periodic rate for each billing cycle. For the purposes of this course, we will use monthly periodic rate to calculate finance charges for billing cycles. Let's check our understanding. If a monthly statement shows a monthly interest rate of X%, express the APR algebraically. Well, in the last example, we had the APR divided by 12 to get the monthly. So if we take the monthly rate of X and multiply it by 12, then we will get the annual percentage rate. The average daily balance is the average of the amounts you owe each day of the billing period. It changes as purchases and payments are made. Now let's compute the average daily balance. Rebecca did not pay last month's credit card bill in full. Below is a list of her daily balances for her last billing cycle. Let's find Rebecca's average daily balance. The average daily balance is an arithmetic average. The arithmetic average is also called a mean. To find the average, you add the balance for the entire billing period and divide by the number of days. By adding up all of these days, we can see that we have 30 days in this billing cycle. With 7 of those days owing $456.11, then we get $3,192.77. 3 days owing $1,177.60 gives us $3,532.80. We do this for every single one of the entries where we multiply the balance that was owed by the number of days it was owed. Then we add up all of these numbers to get $43,248.05. Now, dividing this by the number of days, which was 30, we get $1,441.60 as the average daily balance. Now, let's check our understanding. Last month, Paul had a daily balance of X dollars for 6 days, had a balance of Y dollars for 12 days, W dollars for Q days, and D dollars for 2 days. Express the average daily balance algebraically. So X dollars for 6 days gives us 6X. Y dollars for 12 days gives us 12Y. W dollars for Q days is QW, and 2 days at D dollars. Now, this is going to give us our total. If we add up all of our days, we get 20 plus Q as the number of days. Since this is the total amount of money, divide it by 20 plus Q, the number of days. Finance charges are not charged if, in the previous month, the revolving credit card bill was paid in full. If you pay your card in full every month, you will never pay finance charges. So Rebecca, from example 3, pays the finance charge on her average daily balance of $1,441.60. Her APR is 18%. What is her finance charge for this billing cycle? To do this, the finance charge is going to be equal to that monthly percent divided by 100 and then times the balance. So if she has a monthly APR of 1.5%, and that's because it's 18% divided by 12, by putting the divide by 100, we convert it to a decimal. Multiply that by the balance of $1,441.60. We get a finance charge of $21.62. Now, let's check our understanding. Steve owes a finance charge this month because he didn't pay his bill in full last month. His average daily balance was D dollars, and his APR is P%. Express the finance charge algebraically. So we know to find the finance charge that we're going to take the annual percentage rate and divide that by 12. We're also going to divide all of that by 100, and then we're going to multiply by the balance. Another way that you could write this is 0.01 times the APR divided by 12 times the balance.